I think what I'll do here first is I'm going to start with kind of a summary of what I see as the most important things that happened that I think are affecting the stock market. One of the big pieces of kind of getting ready for your retirement, for example, and working through your retirement is making sure that your assets are doing what they need to do. So we put out a daily video, a market update, which kind of gives you a good feel for what's happened that day, but also I think it's educational. You start to learn what's important about the stock market and where do you get your emphasis from. So today we're going to talk about what's really important this week, which really has to do with jobs. And so I'm sharing a chart here from Market Watch. The jobs report just came out today, and so there was 850,000 jobs created in June, which is a really good number, actually. In the world of the investment world, when the market is looking at job growth, it likes to see a certain amount of job growth, but not too much or not too little. We call it the Goldilocks zone. And 850,000 jobs just seems to have made the market quite pleased today. But you can see what happened here. We had a tremendous amount of job loss during the shutdown of the pandemic. And then, of course, we started to see some, recovery, and we've had a nice movement here. If we look at it another way, it's just a percentage of the population that's unemployed. And you can see here in 2019, we were essentially at around a little over 3%. We shot all the way up to almost 15%, but we've been coming back down. As all of these jobs have been added, we're back down to 5.9%. So one of the keys that I look at when I look at this is, first of all, which direction is job growth going? So it's obviously going upward right now. We're recovering. That's very important. But then secondly, once we start to get really low down here, there's some potential inflationary pressure. And so that's one of the things that the market's worried about right now is that, if you don't have very many people looking for jobs, you would end up with a situation where you have to pay more for each one of those employees. So that's creates inflation. One of the biggest costs that go into product is a person's, labor and such too. So here's another way to look at it. This came out of the New York Times. This is from the Bureau of Labor Statistics. Shows the number of jobs that we had prior to the pandemic, the big loss of jobs in total by April of last year. And you can see we fairly steadily recovered those jobs, but there's still 6.8 million less people working right now. So there's still a long ways to go. We have and the Federal Reserve has been very focused on trying to keep their policies for easy money in place in an attempt to get these people back to work, as far as that goes. But here's something incredible that's happened. Even though we have 6.8 million people less working in the workforce right now, we've actually been able to move the gross domestic product. Okay, so this is the total production of the country, which you can see has been growing very nicely and then fell very heavily during the pandemic. But we're actually all the way back to where we were before the pandemic. So essentially, we're producing as much as we were, actually a little bit more, with less people. That's why the market's doing so well, because if you can generate the same amount of revenue with less labor, you're going to have more profits. And so those profits are driving the market. The S&P 500 is up a little over 1% so far for this week. It's gone up every single day. We've been hitting new records every day. That's because we have high profits coming out of this situation. So imagine what's going to happen as these people start to get back into the workforce and we start to absorb that 6.8 million. We're going to continue to see profitability, mainly because we should see some economic growth as those people start to make more money and what have you. And so here's the most fascinating thing, though, about this whole week, and that's this chart here. This is the number of job openings. This is going back to 2018. You can see there was roughly 7 million job openings, and then it dropped. But look at this. Right now, we've had this big run-up in the number of job openings. So there's 9.3 million open jobs. So think about that for a minute. 9.3 million open jobs, and we've got 6.8 million people that are out of work. Doesn't make any sense. And so Indeed, which is a job search website, did a survey, and what they found is only 10% of the people that are unemployed are currently looking for a job. So that's kind of surprising. And in that survey, they asked why. Number one reason was people were afraid of the virus. So a lot of the jobs that were lost were really lost in the areas where there was a risk of catching the virus, at a restaurant or a hotel or these indoor type places and what have you. So that's number one. Number two is really childcare, which also relates to the virus. And so, if you have a child at home that you need to care for, it's hard for you to go off to work unless you have daycare or school, both of which have been somewhat compromised by the virus. And then the last thing, and this is coming from the politicians and the press, which is just, hey, everybody's getting $300 extra a week by being unemployed. Maybe they don't want to go back to work. And so, all of these things are probably resolving themselves this fall. The extra unemployment drops off in September. Hopefully schools start to reopen and that creates a situation where people can go back to work. And maybe as more vaccines come in and people get more comfortable with what's happening, they become a little bit more secure about, going back to work in terms of the risk of the virus. So really fascinating as far as that goes. This week, is jobs week because of these reports that come out this week, and you can see the market kind of responding to that. And really, we've seen some decent, returns from the market, especially in the large growth area of the market, the tech stocks and those things. And a lot of that has to do with the fact that the market seems to be pretty okay with the job growth that we have going on right now. But the key issue for the market going forward will be the threat of inflation. And so this is what I would focus on if I had to look at one thing that had related to the job market. This shows the average hourly pay. And it basically looks back 12 months. So how much is the average hourly pay now versus where it was 12 months ago, and how much is it higher or lower? And so what you can see here, so you look back 2019, over a 12-month period, wages were growing at about 3.7% per year. Makes sense. And then actually wages grew on an average basis during the pandemic, which seems really counterintuitive until you think about who got laid off, which was low wage people. All right. White collar wasn't as affected in this particular downturn. And so that was when you're left with higher wage people, the average pay is going up. So that's sort of an anomaly. You can kind of ignore that. What you really want to pay attention to here is this recovery that we're having. And so we're currently at 3.6%. This June versus last June, there's 3.6% higher pay per hour on average across the country. That's right in line with where we were. That's perfect. That's the Goldilocks zone. But where does this go? Right? Does this stay and start to go sideways here, stay at around 3% growth, month over month versus last year, or does it go up a lot? And so this will be a really big area as far as that goes. And so that's one of the things I would focus on. Those are the things I think are important. Right now, the numbers look really good. And, you don't want them to get super good in terms of these numbers just because that can create inflation, which can bring the market down or at least cause volatility. It would like to see this kind of even recovery. And so one of the things that's contributing to the even recovery will be the global recovery. Here in the U.S., we've had, you can see, a lot of job growth. A lot of things are coming back around. A lot of vaccines been distributed. Things are reopening. But that's not quite true, when you look at the rest of the world. One of the things you can look at is what's called the mobility data. So this is tracking, how many, cell phones and how much they move. And right now in the U.S., the mobility data is negative 17%, which just means that people are moving about 17% less than they did February of 2020, so before the pandemic. So there's still some room for growth because movement is associated with economic spending and growth. Part of that movement might be people not going to work, those types of things. So once they start getting out and going to movies and going out to restaurants, things will grow. But if you look at the globe and you look at all the major countries where they're tracking mobility data, it's down maybe 25 to 30%. And so there's a lot of room for growth. Australia just locked down again, and they're only at 8% vaccine rate. So as that starts to develop and as those things start to reopen, we'll start to see international travel. So there's a whole bunch of things that could happen here to really create a good economy. And so we'll have to see, if it grows too fast, too slow, or just right. And that's what we're looking for in terms of the market. So really fascinating week, actually. And this is just an incredible time period. I think the market is a good place to be right now with where things are going. And, the Goldilocks zone seems to be, happening for us as a whole. And we're starting to see some fairly consistent gains. So, really look forward to kind of seeing what's going to happen, next week too. So.